Hi everyone, good morning. So today we are starting with leverage, beta asset, leveraging and deleveraging, and re-leveraging of beta, and why do we do uh, these things in finance. So to start this session, let's start with a question. So let's try to understand this. If two companies do exactly the same business, can their stock risk uh, look different, or would the stock risk would be same? And yes, most of you might think that it does not make sense, but in reality it does make sense because of the debt. So okay, so now we are all set. So companies beta is actually the beta is actually uh, that you see on the Yahoo Finance or Bloomberg or Capital IQ. There are many internet websites which also release the beta numbers, equity beta numbers. So beta numbers actually reflect two types of risk. The one risk is business risk, and the another risk is financial risk. So what business risk is, that how risky the company's industry and the operations are. Example is that, let's assume that we are selling soda. So soda is less risky than drilling for oil. And when we talk about financial risk, um, it's how much extra risk comes from using debt. So more debt is equal to more risk for equity investors. Why is that? Since we are talking about it, more risk is more, the risk increases for equity investors, not for debt investors, because debt investors are they are going to get their interest payments, and at the end of the time period, the debt is going to be paid off to the debt investors. So the more we increase the debt, the more risk will be increased for equity investors. So this is basically the concept. Uh, and when we unlever the beta, so the meaning of unlevering is, so lever actually shows the effect of debt, and unlevering means that we are removing the effect of debt. Uh, okay, then why should we want to pretend the company has no debt? So this also raises a question: why we are assuming that the company has no debt? Uh, and to isolate pure business risk, we need two identical companies. Let's assume example where there is a restaurant A and restaurant B. So one has no debt. Let's assume that this has no debt, and we are assuming that this is highly leveraged, and leverage means debt. Just remember this. When we are talking about leverage, we are talking about debt. So even though they run the same business, restaurant B, if they are listed on the stock exchange, so restaurant B's stock will look more riskier because it uses more debt, and not because its food or customers are riskier. To understand this thing, we just discussed about this part. Taking more debt is going to make the company riskier for the equity investors, not for debt investors, because debt investors, they thrive on the interest payments, and at the end of the tenure, The the debt investors are going to get the principal amount, and the equity investors, the more the debt increases, the riskier the company gets for equity investors, and the companies are actually listed on the market. And listing on the company listing on the market means the equity investors, it's for ownership stakes. So this is pretty much the concept. So that's why more debt increases, more risk. And unlevering means that we are actually removing the uh, effect of debt from the company, and then only we will be able to compare apples to apples. I mean, the comparison of apples to apples. We will be able to do apples to apple comparison. But first, we need to unlever the effect of debt. Unlevering itself means the removing the effect of debt. We actually have to unlevering. We have to do some unlevering. Okay, so unlevering removes the financial risk. This matters because two firms doing exactly the same business have the completely different equity betas just because one uses more debt and one does not uses any debt. Uh, okay, why we relever, delever, and then relevers? First, we remove the effect of leverage, then we delever, and then we again relever the beta. Once you know how risky the business truly is, why do we add debt back? This is why, because each company has its own capital structure and its own combination of debt and equity. So, what an analyst will do or a financial professional will do, first they will remove the beta or the remove the effect of debt, which is unlevering the beta. And then, okay, so why do we do this? This we do we to get the pure business risk, and then we will relever the beta using the target company's debt to equity ratio. So this means that we add back the appropriate level of risk that the of that company, and this gives the correct equity beta for valuation. And since beta is related to the cost of equity and which is related to the weighted average cost of capital, this step is actually essential for accurate valuation. This much portion. So let's uh, go further in the reading. So reason one is that to value the private company. Now understand this thing. The private companies don't have stocks. So where do we get the beta? And we cannot get their betas. To value a private company, take we need to follow a certain process. And so we take the public companies beta, we unlever their beta, and then we average them and relever the private firm's capital structure. This is the step-by-step process that we do when we are valuing a private company. And we will see that, okay, the restaurant example, just remember this. Let's assume that one restaurant is listed on the stock exchange and they have a public beta. And you can only obtain beta when the company is actually listed in the market. And uh, yes, then only you will be able to obtain the beta because you need to you need to find the correlation between the company's changes in stocks and the ups and down in the market every day. Then you will be able to find the sensitivity of the stock with the market. So that's how you get the beta from a public company. So you take the public company's beta, you remove the effect of debt, because we are only focused on the equity beta. So you will remove the effect of debt. This is called unlevering. Unlever. Unlever means remove the effect of debt. Then we will average them. The multiple companies, we will use multiple public companies. We will average them. We will find the average beta, and then we will relever the private company's capital structure using this beta. This will give us the beta as if the private companies were trading publicly. So this is the main reason. Second reason is to compare companies in the same industry. Many industries have widely different leveraged levels, like airlines, energy, telecom. They have highly variable leverage because these type of companies are very capital intensive. That's why they have high leverage. So airlines, because of obvious reasons, because of airplanes, energy, because of drilling and a lot of labor involvement, telecom, again, because of capital assets. There are a lot of towers to do. I mean, one example is towering. A lot of infrastructure is involved in telecom. So these are highly leveraged because of these are capital intensive uh, industries. If two companies borrow different amounts, so we should not be directly comparing their equity betas just on the basis of the borrowed amount. So unlevering actually allows meaningful comparison, and directly comparing equity betas would be misleading. So just for instance, I am comparing the betas. So I'm just assuming that this is the beta. No. So directly comparing the beta would be misleading. So we need to actually first deleverage the beta of those similar companies. We remove the effect of debt from those companies. Then we get the financial risk involved with the market. We remove the financial risk, we get the market risk. Then we use then we use to calculate uh, then we relever and then we get the company's capital structure. On the basis of the capital structure, then we fix everything. So this is how we actually this is how the capital CAPM, the capital asset pricing model is done for private companies. Okay, so to estimate the beta, or the third reason is to estimate the beta under a new large capital structure. To estimate the beta during acquisitions or buyouts, companies often take on much debt. And so we unlever, we then apply the new debt equity ratio, and then we relever. And this gives us new beta, and therefore the new weighted average cost of capital after the deal. And this is absolutely essential for forecasting and valuation changes. Yes, this is confusing. Leveraging, deleveraging, and unlevering this concept. It's little confusing, but this is a very essential topic, and we need to discuss it. Uh, just in simple words, just understand this thing that beta represents. We need to calculate beta. We actually need the beta, and beta can be only obtained of public companies because it's the relationship between the market and the stock. So for private company, we cannot use this beta because this beta belongs to some different company. And the beta will be influenced by the capital structure of the company, capital structure of the publicly listed company. So what we need to do is we will take this beta in simple terms. We will remove the effect of uh, debt from this beta, and then we will get the effect or the risk, the pure risk of equity of the publicly traded company. And we will not be taking just only one example. We will be taking multiple companies, and then we will average the beta of those companies, and then we will use this beta, the averaged beta, for our private company valuation. And private company valuation, the cost of equity is calculated using CAPM. And for this, we will be needing beta, because the formula for CAPM is uh, RF minus RF plus beta, RM minus RF. Risk-free rate, market premium, beta. So we cannot calculate the CAPM without beta. So that's why it's important to leverage, deleverage. And this is how the valuation of private companies is done. So if you ever encounter a question where they're asking you, how do you value a private company? Yes, this is how we actually do this. How this is how actually we value a private company. But understand this thing. Basically, you need a rate. First, you need to have a rate. Then only you will be start. Then you will be only perform your valuation. But unless until you have a rate of return, so expected return, weighted average cost of capital, these are the elements which are used for discounting or for compounding. So if you do not have the rate at which you are valuing or discounting your cash flows, and the oh yes basically cash flows, so you will not be able to perform a valuation. And to calculate the rates, you need to calculate or look into the elements which are actually calculating or the primary inputs of the rate. So beta is actually a primary input to calculate the rate, and that's why this we are making this video where we are discussing about releveraging and leveraging of the beta. Okay, so in real world examples, let's understand uh, the example where Coca-Cola is compared, when we compare Coca-Cola versus Monster beverages. So both sell beverages, but one uses heavy debt and another company does not uses debt. So let's assume that Coca-Cola, the ticker is KO. So the equity beta is 0 0.4, approximately equal to 0 0.4. And when we talk about Monster beverages, the ticker name is MNST. The Because of no debt, the equity beta is 0.85 to 0.90. So because of debt, the equity beta is reduced here. It looks reduced and the interpretation of the raw equity beta is that it's safer. And because there is no debt involved, it looks more riskier. And the equity beta is 0.8 to 0.90. But this appearance is actually partly misleading. Coca-Cola's lower beta is influenced because of its large use of debt, which increases equity risk, but Coke's operations are extremely stable. And this is actually important. And that's why it's actually reducing its equity beta in the market. This is actually masking the leverage effect. Coke actually uses a lot of debt, which inflates the equity risk, and Monster has no debt. So equity beta reflects peer business risk. But when we unlever, when we unlever the beta and we look into the Coke's business operations, so Coke's unlevered beta is 0.36 and Monster unlevered beta is 0.9, which is already they are not using any debt. So now you see that Monster's business model is genuinely more volatile than Coke's stable business model, and This is where we are comparing two possibilities because we unlevered the beta. So yes, initially also the Coke's beta is low and Monster's beta is high even after no debt. So it does looks riskier and it does look safer because of because what the market believes. And the market believes because the Coke's operations are extremely stable, that's why the beta is lower. The equity beta is lower for Coca-Cola, and the equity beta is higher for Monster beverages. And uh, you need to analyze everything, not just you just not mug up the information. You need to analyze everything. So this is the analysis part where the yes, it has gone differently. What we have been learning so far, we have associated risk with return. We have associated that we have talked about that more risk means more beta. But here in this case, because of extremely stable operations of Coca-Cola, the Coca-Cola's equity beta is lesser than Monster beta, whereas Monster beta has no debt. And previously we discussed that because of debt, the equity beta also increases for the equity holders. But in this case, it's uh, incorrect, not incorrect, but it doesn't apply here. So that's why the things we learn in theory and the things we do in practice, they are different. Okay, so I hope this example has given you a new perspective, a new direction to think into. And if it has done this much, it's great learning for you guys. And my efforts have been, uh, I mean, whatsoever effort I have put in, that has actually been successful. So let's talk about Ford and Tesla. So both of these companies are actually automakers, but their capital structures are very different. Tesla is riskier than Ford. If we look at this, the equity beta and the equity beta of Ford is lesser than Tesla. This is giving us of impression that um, because of because of high equity, Tesla will be more riskier and Ford is less riskier. But the Ford actually has high debt and Tesla actually has low debt. And because of high debt and the other advantages we get in our capital structure, the weighted average cost of capital because of debt. So the okay, let's not talk about this. Uh, so debt actually makes equity riskier, but here in this case, it has reduced the equity beta. And here, because of lesser debt, higher beta is mostly the business risk. But here we are using low debt. And if you compare the raw betas of both the companies, so raw beta of Tesla is 2, uh, 2.0, and Ford seems moderately risky. The beta is 1.4. This is misleading because Ford has much higher debt to equity ratio, and which magnifies the equity beta. And if we unlever the beta of both the companies. This is okay. We are not talking about the calculation, but only the interpretation, because these are just examples. We will talk about these kind of things when we will do a private company valuation. We will practically do this. So if we unlever the beta of Ford and when we compare the unlevered beta of Ford and Tesla, unleverage means after removing the effect of debt. So we can see that the Ford's unlevered beta is 0.65 to 0.75, and the Tesla's unlevered beta is again 1.6 to 1.8. This is again high even after removing the effect of debt. And why is this happening? Because Tesla's business model is much more riskier and more volatile than Ford. And Ford's lower beta only looked lower because debt distorted the picture. So this is the interpretation here. In the world of finance, there is a lot of possibility of anything can happen. So even though we have unlevered the beta, so this number is actually representing the beta of equity on itself. This beta is for equity because we have already unlevered it. We have removed the effect of debt. So this was debt plus equity. This is debt plus equity. But this is purely the beta is for equity in this case. Here we are discussing purely about equity beta. And why the equity beta of Tesla is high? Because of uh, Tesla's business model, which is riskier and more volatile than Ford's business model. For this, you actually have to understand the company's business model. Business model, you need to understand the business model. And one reason could be that Ford is majorly into cars manufacturing only, but Tesla is into multiple things. So this is actually increasing the Tesla's beta. Right. So I hope this was clear. Example number two. And example number three, let's discuss one more example. Utility companies with different leverage. Utilities often have extremely stable cash flows, but huge borrowings because of uh, high capital investments. Utilities, let's take example of Duke Energy and Next Era Energy. So equity beta for Duke Energy is in between zero point 0.5 to zero point 0.6, and for Next Era Energy it's zero point 0.35 to zero point 0.4. So looking at the equity beta, Duke Energy looks more riskier and Next Era Energy looks less riskier for an equity investor. But but the debt to equity ratio is highly leveraged for Duke Energy and, and mediumly leveraged for Next Era Energy. And after unlevering, the nearly all utilities companies used cluster around beta of 0.3 to zero point 0.4, uh, showing the true business risk is similar across the industry. And this is why analysts nearly always use unleveraged industry betas for regulated utilities. So the real business risk is almost identical, and the apparent differences were caused because of leverage. So this is uh, for both these companies, but the difference in leverage is because of uh, debt. Here the debt is high, here the debt is low. So three examples, and three examples had three different interpretations. And whatsoever we have read in theory did not apply it here. And it actually challenged what we have discussed previously. And this is why, this is actually the reason why what we read in theoretical knowledge and practical knowledge are both different. You need to apply your theoretical knowledge into real world scenarios. And most of the time, you will see that you will be questioning your knowledge. And this does happens. In most of the cases, you will be questioning your own knowledge. And most of the time, you will not be, whatsoever you have learned in theory, you will be challenging that. And the market will be going against you, what you have learned in theory. But then you actually have to dig deep into the picture, and you actually have to perform a analysis. You actually have to connect all the dots, because when you look at a picture in isolation, you do not understand anything. But when you look at a bigger picture, then only you understand why is happening, what is happening, and why it's happening actually. Okay, so the key takeaways from this topic is we unlever beta by removing the effect of debt. Yes. We relever, we add back the appropriate risk for the company being valued. And without unlevering, companies beta are meaningless. So debt actually, the effect of debt distorts everything. Distorts means it amplifies or uh, doesn't gives the true picture because of the debt involved. So that's why we actually have to remove the effect of debt. And the standard valuation sequence is usually we unlever, then we average the peers, and then we again relever. And it's used for private company valuations, merger and acquisition deals, LBOs, changing capital structure, cross industry comparisons. And okay, changing capital structure. When a company changes capital structure, the whatsoever calculations we have done previously, those also changes. So you when we do a valuation, we forecast into the future. We forecast into the future on the basis of these calculations in the current time. So we are assuming that this is much is the weighted average cost of capital today. So if the capital structure changes in the company, inside the company, they have raised more debt. So this number, this weighted average cost of capital also changes. And this is one of the drawback of weighted average cost of capital, using the average cost of capital. So because we when we are doing a valuation is not a one time job. You actually need to track and update your valuation on whatsoever the information is released by the company. So this, if you are getting into valuation, so valuation is not just a one-time job that you have valued a company and you are saying that this much is this should be the price of the company, this should be the stock, the price of the stock in the market. No, you actually need to track your valuation. You need to track all your assumptions frequently, and you need to update your plugins, all these plugins, and you need to update your valuation from time to time, whether you want to hold, you want to sell, or you are recommending the market to buy. So that's one difficult aspect of valuation. So this is pretty much it about leveraging and deleveraging. in so we have discussed over the concept, and in the next concept, in the next session, we will be discussing about how do we unlever the core formula and everything associated with leveraging, deleveraging, and releveraging. All right. So thank you for attending today's session. I'll see you soon in the next video. All the very best.